Good afternoon, everybody. A little bit different for our show today. We are not going to be going live and having a panel discussion as normal. My workload has prevented that today. Incredibly busy and lots to take care of. But what we strive to do is to keep these shows informative, and that's the whole purpose, is so that you guys can learn and hopefully adapt and come out of this stronger. So today we are sharing this fantastic webinar series from our corporate tax lawyers, and they're going to touch upon everything from PPP, disaster relief loans, some employment things. It is Florida based, so they are going to talk about Florida statutes and things like that. However, it does apply. It does apply to most of the states nationwide. So I think it's going to be very informative, especially recently, the hot topic of the force majeure clauses in people's insurance, and people have had questions about that, and they do talk about that. There is a lot of information, and I realize that Friday you probably don't want to sit down and watch a tax seminar, but I think it is going to be incredibly useful to you. So if it is, or if there's something else that you want to learn about or know about, please put in the comments below, and we'll see what we can do and get the right people on board to give that information to you. I am still getting through the list of people that initially let me know that they were wanting to do the talk show, and I'm still looking for new guests, or if you've got suggestions of people that you want to hear from, then again, put them in the comments below, or even better, send me an email, mike@galaxymultirides.com, and then we're going to expand the format. So when things do eventually get back to normal, or some resemblance of normality, we're still going to continue doing these shows, but hopefully with a bit more of a positive twist, when we're going to talk about equipment reviews, tips, processes, hiring people, all kinds of things, so we can share this wealth of experience and make our whole industry better. In addition to that, I know that we've been doing this in video, and we'll continue to do that. However, we have the option to do just audio as well. So this more than likely will be going out as a regular podcast. So if you do, I need people to get involved, because without you, then who wants to listen to me speak and ramble on about nonsense? But I'm gonna make the first 4 episodes available as audio downloads for those that couldn't sit in front of a computer and watch them. But for now, I'll hand you over to our corporate tax lawyers and for the Friday fun tax seminar. So please leave your comments and feedback. We'd love to hear them and see what you guys are thinking about what we're doing. And get in touch, and we'll get you on live, and we'll do something fun. So take care, have a great weekend, and stay safe, and we'll speak to you soon. Thanks, guys.
Hi, this is Alan Gassman, and I'm here with Brandon Ketron and John Beck, and we welcome you to this webinar. I hope everybody is healthy, happy, and much wiser than you were 3 or 4 weeks ago before this interesting black swan event that we've had. In the past 2 or 3 weeks, since Marcia and I came back from vacation in Argentina and Chile, it's been very interesting. I've rented an Airbnb house about a half a mile from the office so that I can be quarantined, just to be safe. Marcia's at home, and I go home every night, and we get along well during the day since I'm here and she's there. Brandon and John are at the office. Everything's going well at the office. We have about 2/3 of our normal staff there, and they're being very careful. They're very spread out, and they're having a much better time because I'm not there with them. So we're going to cover a lot of information today, a lot of things that we normally cover when we give these webinars for professional advisors, and I know we have a lot of clients and a lot of professional advisors on here. This was promised to be a 1-hour talk, and we're going to keep it to that. I've got a table of contents here on the first page that gives you an idea of what we're going to cover. And if you need to find things when we're done, you've got a couple pages of table of contents. Some of the things we're going to cover include, as you see on page 4, Florida stay-at-home order. We're going to talk about IRS filing extensions. We're going to talk about charitable contributions. We're going to talk about pension and IRA distributions. We're going to talk about life insurance, estate planning, powers of attorney, insolvency. The list goes on. I hope you're not asleep already. Page 6 is the article that we posted to Forbes on my Forbes blog April 5th. It talks about the governor's order telling people to stay at home. The big news here for me was that it said that if you're a senior citizen or somebody with one of several specified medical conditions, you had to stay at home, and that if you were anybody else, you should stay at home except for essential services. The governor later modified that to say that even senior citizens can leave home for essential services. That means the senior citizen is either providing an essential service or is receiving an essential service. And the essential service list is, to our knowledge, the most extensive list of anywhere in the country, because Governor DeSantis not only gave his own list, but then incorporated the Miami list and incorporated the CDC list. And then later issued questions and answers, which gave even more exemptions. I think the scientific answer here is that if you follow the governor's order, you can certainly go out and get the virus anytime you want. But if you want to be safe, then you'll not obey not only the governor's order, but also, if you can at all, stay more than 6 feet away from other people, wash anything that somebody else touched before you do, and wear the face mask when you are out and about in order to be safe. This particular face mask was given to me by a physician client who said, do me a favor, I'm going to need you over the next few weeks. Wear this mask when you're with anybody. So it has improved my appearance, but it's also going to make things a little safer. Marcia and I do not have any family members who are presently diagnosed to have the virus. Our law firm does have at least 3 clients in the hospital with the virus. 2 of them are physicians. One of them is in intensive care and is not going to be well for a long time. So this virus is very, very real. I hope that you have not experienced it or have anyone else close to you experience it. You can read the Forbes blog for more information. I was a little bit upset that the governor said, well, go ahead and go to religious events and no rules apply. No distancing applies at a religious event. I hope that people are very careful with Passover and Easter and not naive to be risking their health. It's really better to stay healthy. One statistic I learned was that 80% of people who have been on a respirator for this virus have died. So it's not, maybe the worst thing is that you need the respirator, not that you can't get one because of that high death rate. So I hope you're going to take this disease very seriously. Don't be embarrassed or feel bad if you're being safer than other people. Now, what I was able to do was I got into an Airbnb before Executive Order 20-87. The Executive Order 20-87 says that the short-term rental of houses in Florida and condominiums is not permitted. So you could enter into a 181-day lease if you want more space than your present home, or you want to put somebody in a protected area. You could contact an Airbnb owner. You could sign a 180-day lease or a 181-day lease, and perhaps it would be okay if there's a cancellation clause that either party could cancel on 30 days notice. That's just an idea to try to stay safe. Now, on the landlord and tenant situation, residential foreclosures and residential evictions are presently not permitted in Florida. But people who are not paying their rent or paying their mortgages have a bigger risk, and that is that the landlord or the mortgage company is going to call the mortgage or kick them out of the lease. We represent a lot of landlords that are quite concerned. They don't know what the vacancy rate in their buildings are going to be after this virus, especially for commercial space. A lot of bars and restaurants probably are not going to have the cash flow to reopen. So we'll just see what happens here. Marcia and I have been ordering a lot of takeout in one reason, just to support the local restaurants that we like, to hope that they'll be open when the virus thaws out. But these things, of course, are happening. Now, at your doctor's office, we represent a lot of physicians. I'm sure there's a few physicians on this call. Because they don't want to have their patients or employees infected, and they don't want to be infected themselves, doctors have had to be very careful. As I said, I've got a couple of doctors who already have the virus and a number of other medical personnel who have at least been exposed to it. So hats off to those people. But doctors now can do video calls and get paid the normal rate visit by Medicare and many carriers for a video call. So I had a scheduled well visit with my doctor, and instead of canceling it, because I didn't want to risk being exposed or exposing him or his staff, I just set it up as a webinar, and we used the Baycare webinar system. It was pretty easy to do, but I have to admit I had to have one of my assistants figure it out. I couldn't figure it out, but they can walk you through it on the phone. If you have a Baycare doctor or a doctor who uses video conferencing, you may want to go ahead and sign up for their system. And if they're slow, you may want to have a well visit, tell them how you're doing. If you have symptoms of the virus, then the majority of healthcare carriers are waiving any deductible and any copay if you go just to get yourself checked out. So be in great shape. I hope everybody's exercising. There's time that you can't say there's not enough time to exercise anymore for most of us. There is time to exercise. There is the opportunity to eat properly. Marcia and I are using grocery delivery. We're not going to the grocery store. The grocery store we were going to had 2 of the employees there come positive. So we're just using delivery services or hiring people who are willing to deliver to do our shopping. Now, page 22, it's a good opportunity to update powers of attorney. If there's the possibility that more people are going to be getting sick, especially older people or people who are not in good condition. So if you're a client of our office, we'll be glad to send you a copy of what you have now. You can look and just make sure that it does what you want it to do. If you're not a client of our office, or a friend of yours is not a client of our office, and they executed a power of attorney after 2010, then they want to make sure it complies with the Florida laws, because a lot of powers of attorney don't comply with the 2010 Florida law, and therefore have zero force or effect. For example, if the power of attorney was signed in 2012 and says my wife Molly will serve as my agent, but only if I'm incapacitated, then that power of attorney will have zero force or effect. Or if the power of attorney says I authorize my agent to do anything on earth, but it doesn't specifically say to transfer my car or to sell my house, then you can't transfer the car and you can't sell the house, because the power of attorney has to specifically authorize everything that would be done. So it may be a good idea to check and make sure that you have powers of attorney. Those were the financial powers of attorney rules I just discussed. Now, the healthcare power of attorney, it is a good idea to update these as well. You can now provide in your own healthcare power of attorney who would take care of your children if you have children. So the same people you appoint under your healthcare power of attorney can also take care of your children. Also, just so you know, the healthcare power of attorney authorizes your agent to go behind your back and go talk to your doctor or your psychoanalyst or your addiction advisor about your situation without telling you about that. unless you have special language that addresses that. Now, in addition, almost all of our clients have pre-need guardian designations, which say, if I ever go crazy, here's who I want to be my guardian if the court ever requires a guardian. And then, of course, if you have minor children, you should have a healthcare power of attorney to designate who can make non-emergency decisions for your children if you're not available. Now, the living will is a document which allows life support to be withheld, and you may want a stronger one or a weaker one. You may want it to require that two physicians in the specialty of the problem that you have look at you specifically and carefully. You may want to require a 48-hour wait before anyone could ever pull the plug, or you might want it to go faster. So there's language here on these PowerPoint slides that you can look at and consider. You may want to give somebody the power to override the power of attorney. We normally do. Let me mention on the healthcare power of attorney, most people say, I'm going to give this to my wife, Molly, and then if she can't serve, to my friend John. If John can't serve, then Mary. Well, then they end up in intensive care, and Mary gets there first. Molly's all upset. Mary gets there first. Well, she can't serve unless Molly resigns. So why wouldn't you go ahead and name 4 or 5 people and say, whoever gets there first, whoever happens to be there, if they're visiting me at 2 in the morning, and they want to look at the medical record and ask the nurse why I haven't had my last round of medication on time, why wouldn't they be able to do that? So that's just a healthcare power of attorney tip. The do not resuscitate order is a yellow sheet of paper signed by the doctor, posted on the refrigerator at home or on the hospital bed door, which says, don't resuscitate me. If I code or I'm not breathing or my heart stops, don't resuscitate me, because I don't want all of the pain and agony involved with what happens when you do CPR on an older, frailer person and break a lot of ribs. So it's different than the healthcare power of attorney. There's a lot of confusion there. So I just wanted to mention it. Florida is not a right to die state. It can be very difficult to die in Florida. We've had clients that would want to have died earlier. They weren't able to. So I'm just pointing that out. Oregon has a much more favorable legislation, and we have had clients move to Oregon in part for that reason. So make sure you know where your living will and your healthcare power of attorney is. If you can't find it, let us know. We'll be glad to send you an email copy. An IRS notice came out, I believe, yesterday or the day before, relieving taxpayers from a lot of things that we've normally had to do right away. For example, when we set up an S corporation, when we set up an offshore trust, when we set up a new parent company to own a subsidiary company, we're supposed to file certain documents by certain periods of time. And the IRS has been graceful enough to forgive and to push back both filing dates and due dates, noticeably including estate tax returns and gift tax returns, which they've almost never done. So that just happened, and I've got the list here. So your CPA can take a little bit of a chill, maybe not be under quite as much pressure if they know about this notice 2020-23, which, now that I think about it, just came out yesterday. So your CPA might not even know about it. And your CPA is really, really busy helping people fill out the salary participation loans, which Brandon is going to cover in a few minutes. Something that happened under the federal law that I think is very pertinent, and you should know this if you're an employer, you already know, but if you have children or loved ones who are employees, if an employee of any business in the United States has a quarantine or isolation order and can't work because they're not able to work from home, or they've been told by a healthcare provider to stay at home, or they have symptoms and they're out getting a diagnosis, the federal government pays the employer to pay the employee for paid time off at their regular rate, up to $511 a day, up to $5,100 total, and the employee has the right to insist that they be able to stay at home under these conditions. The only exception to this would be medical offices and medical businesses where the employer determines that it would not be a good idea to have this rule apply in their office. Then under items 4, 5, and 6, which you can see by the arrow, if the employee is caring for somebody else who's under 1 or 2, or is caring for a child, then they get 2/3 of their normal pay for up to 80 hours. These are up to 80 hours. Now, in addition to that, if they are unable to work because they have a minor child at home who needs child care, then after the 80 hours up here runs up, the employee has to use their own PTO for 2 weeks, and then after that, the government chips in and gives them up to $200 a day or 2/3 of their regular rate to stay at home with their children. And, you know, one thing we've noted here for a lot of people, and I don't know that it's happened for you, but hopefully it is that relationships have been significantly enhanced as married or unmarried couples have less complications and have more time together, fewer interruptions. There's more time on the phone or on FaceTime or video calls with children and grandchildren. People aren't necessarily as busy. And a lot of clients have told me that they're glad it happened. Not from an economic standpoint, they're not glad it happened that people are dying, but that they realize that a little bit of a simpler life, a little bit more time and attention with family, and certainly everybody's dog is happier. Now, my friends at Hub Insurance, Holly Kerr, gave me this summary showing that a lot of health insurance plans are doing some very nice things. They're waiving copays, they're waiving deductibles if you have anything relating to the virus. They're also allowing people who used to have to work 30 hours a week to keep their health insurance to be furloughed and to be able to keep their health insurance. Not all the carriers have necessarily done this, but most of the carriers and also Medicare. So I've just given you some of the things we've received here. And like I said, you can now do video calls with your doctors. In the past, it was very difficult for a doctor to do a video call. They had to have a lot of special equipment and computerization to comply with the privacy rules. And the federal government said, don't worry about that. Page 53 simply says that medical businesses can exclude their employees from that sick pay time that I was telling you about. Brandon or John, do you want to cover the $1,200 check that I don't believe anyone in the United States has gotten yet, and the $500 per child check for a couple of minutes?
Sure. So most people know about this already, but every American taxpayer is receiving a check of up to $1,200. And if you have a child, another $500. We have the thresholds here. So if you make over $75,000 as a single taxpayer, or $150,000, that gets reduced for every $5 for every $100 you exceed that. But one planning strategy, now that we have the tax filing deadlines extended, if you would have qualified in 2018, but you don't qualify in 2019, you might want to wait until July to file your 2019 return. That way, IRS will look at your 2018 return, and you could still receive some benefits.
That's a great piece of information. Thanks very much.
And the unemployment benefits have been extended to covered individuals. Those individuals are those who have been affected pretty much any way that caused them to lose their job due to the coronavirus. And these individuals can receive their regular state unemployment amount plus another $600 a week. So there are some individuals who will make more on unemployment than they would by working, and it definitely would behoove some employers to furlough some employees, try to get them to qualify for this rather than paying them if they don't have any work to be done. So on this slide, you can see that it's $600 per week, and you are paid through the state agency. So regular state unemployment will pay you the additional amount, and the states are being reimbursed for this. So this is not supposed to cause an undue burden on the state, even though they will have to process a number of applications. I'm not sure how they will handle that that extra amount of applications.
So basically, a lot of employers who are slow now have furloughed their employees so that the employees can get $600 a week unemployment. I mean, $600 a week plus their unemployment benefit. And then when the virus thaws and businesses can reopen, the employers are going to be able to get a payment from the government, which Brandon's going to talk about under what we call the PPP program, and the employees can come back on the payroll. John, do you want to spend just a couple of minutes on the charitable deduction changes?
So there were two big charitable deduction changes in relation to the CARES Act. The first one is supposed to be permanent, and for anyone who does not itemize their deductions, they can deduct up to $300 above the line, meaning they can benefit from that $300 deduction, but it has to be a cash contribution to a public charity or a private operating foundation. The donor advised fund will not work, and a regular private charity will not work. So that's something to keep in mind here. And then the next change that is not supposed to be permanent is an increase in the amount you can contribute to charity from your adjusted gross income. Now for cash contributions to public charities, you can deduct up to 100% of your AGI. This was previously 60% for these types of contributions, but it has not changed any other AGI limitation. And on this slide, you can see what the AGI limitations are going to be for 2020. The only real difference is that top left percentage, that 100%. Everything else is the same. As you can see on the next slide, this is what it normally is. Now, if you contribute more than 100% of your AGI in 2020, what's carried forward will be subject to these rates, the normal rates. You won't have that 100% of AGI deduction on any carry forwards.
So many of our clients have been wonderfully generous. Some of our clients have given away more than half of their net worth. One client has given away really 80% of his net worth, and the 20% remaining is plenty, but not nearly as much as 5 times that. So a lot of our clients every year form private family foundations, which then may pay their children or grandchildren or others to do work that is charitable in nature. It's a good, wholesome family activity, and it's a tax deduction for putting it in, and the foundation doesn't have to do much, but they have to distribute about 5% of their value each year. So it's something to consider if you have extra time with your family to see if they're interested in doing charitable work. As opposed to just writing a big check to a hospital or a school, you can set up your own foundation that specifically helps the hospital and the school, and the hospitals and the school know how to do these. So one thing we want to mention is when you set up your foundation, you can help people, but you can't help your next door neighbor. You can't help a specific person. Under the Internal Revenue Code, charities are for classes of people. So even when you see someone in the newspaper that had a really bad fortune and somebody sets up a trust just for that person, that's typically not going to qualify. But certainly if you want to help provide benefits for anyone who lives in the village where your parents were raised, or for graduates of your high school who would like to go to the college that you went to or something like that, it's a very nice thing. Brandon, a minute on Section 139 for the clients who own businesses.
Yeah, so Section 139 allows for what they call qualified disaster payments made to your employees to be not included in their income as long as there's a qualified disaster, which there is now nationwide. So employers can make any type of payment for reasonable and necessary personal, family, living, or funeral expenses incurred as a result of the qualified disaster. It's deductible to the employer. It's not included in income for the employee. So it's a nice benefit here to allow for employers to really reimburse their employees for expenses that they've incurred as a result of this disaster. Maybe that's for child care, for medical care, buy new computer equipment to work from home. All that can be paid to your employees, not picked up in their income, and not become deductible for you. So it's a nice provision that you can take advantage of.
Yeah, and you don't have to include it in your pension plan calculations. You don't have to pay the 6.2% due to tax on it. So if you are an employee of your own business, and a lot of people attending this are, make a list of your personal expenses that have gone up as the result of this, and write yourself a check. Talk to your CPA first, and then ask your employees, what have you guys been spending? I see you've had a babysitter. Let me give you a check for it. It's not part of your salary. It's not part of your bonus. It's just something that we do for people who need it. Okay, for very few of our clients lose money, but if you ever do, there are Internal Revenue Code provisions that prevent you from doing very much with net operating losses traditionally. You could carry them back if you have a negative situation in a tax year, which happens a lot to real estate developers every once in a while. You can carry it back a couple of years and actually get a refund as if the loss occurred in a prior year, or then you have to carry it forward. Congress eliminated the carryback in 2017, but now they've given it back to us. They brought back the carryback. If you had losses in 2018 or 19, you can amend that 2018 or 2019 return, carry that loss back to a year before, and actually get a refund. So those of you who had some losses have a real nice advantage, and those of you who have losses this year, and there will be quite a few people with losses this year instead of gains overall, will be able to get a refund from the prior year. So you'll get cash back for your losses, which does help to ease the strain. You're also able to take a bigger interest deduction in your business under this new law. Up to 50% of your taxable income can be an interest deduction for businesses over 25 million in revenue. Businesses under 25 million in revenue did not have to worry about this rule. There was an error in the prior tax law which prevented you from writing off certain improvements to buildings, and this new act corrected that. And Brandon, when specifically does it apply?
Yeah, so it applies for qualified improvement property, which is like Alan said, if you make an improvement to an interior portion of your non-residential real property. The glitch was that under the new statutes, they combined a bunch of different of those. So I think there's 4 different types of categories into one new category of just qualified improvement property. They didn't specify the new depreciation period though, so it had a 39-year life. Well, that meant that it's not eligible for any of the bonus depreciations. No 179 deduction, no 168K bonus depreciation. Now they have corrected that and said we meant to have it a 15-year life, which was the previous life for all those different types of improvement property. So now that it has that 15-year life, we can take bonus depreciation on it. And it's made retroactive for 2018, 2019 as well. So you had purchased qualified improvement or made those improvements in those tax years, you can go back and amend returns, take the full expense in 1 year if you would like to, and get a refund for those amounts.
Okay, so that's another place where a lot of people on this call talk to your CPA. You may want to amend the return and get some money back. Now, there were some new rules that came out very recently which will enable people who were detrimentally impacted by the virus to pull up to $100,000 out of their pension or IRA account without paying the 10% excise tax. They will still pay income tax on it, but they may be in a lower bracket this year. And there's 3 choices if you pull this 100 out. The first choice is that you pay it back within 3 years, and it's like you never took it out. The second choice is you pay tax on it this year. And the third choice is that you pay tax 1/3 this year, 1/3 next year, 1/3 the following year, as if you received $33,333 each year. We are discouraging our clients from taking this $100,000 withdrawal. It's creditor-proof money in Florida. It's going to grow tax deferred. Some of our wealthy clients may pull it out and then wait to see what happens. If you have losses this year, you may be better off converting part of your regular IRA to a Roth IRA or your 401k to a Roth 401k. So think about this one. You do have the ability to withdraw it. What bothers me the most is a lot of middle-class families are going to unwisely take out 100 or for two spouses, 200,000 instead of mortgaging their vacation home or selling their Jaguar or selling their boat. Times are slow. You may have a big recession around the corner. You'd be better off leaving these monies in the pension or IRA and mortgaging the vacation home or the boat. A lot of middle-class families and small business owners, quite candidly, are going to go down the drain and have to start over. And it's easier to start over when you have a couple $100,000 in your pension and IRA account. You could even put a business under your pension IRA account. Brandon and I wrote an article about that. So I've had clients who literally have nothing with judgments against them, and they've been able to start a business under the IRA. Creditors can't touch it. They're able to work for the business. So these changes, sometimes when the government gives you something, you don't necessarily want to take it. Also, there was a law that you could borrow up to $50,000 from a pension plan that allowed it. They moved that up to $100,000. So you're going to have a lot of employees asking you where their $100,000 or $200,000 is. One thing that they also did was if you are a senior citizen, you're taking your annual minimum distributions from your IRA, you don't have to take it this year. Now, if you already took it and you took it less than 60 days ago, then you may be able to put it back and call it a rollover. We just published an article on this yesterday, and we'll be glad to send you a copy of the article if you like to see whether you can do a rollover. But the bottom line is, if you have IRA minimum distributions from an IRA that you retired on or a rollover from your spouse, you don't have to take that distribution this year. If you borrowed money from your profit sharing plan on a 5-year loan, which is allowed, you get to skip payments for a certain period of time. John, what else happened in the CARES Act for pension plans that I haven't mentioned?
You pretty much covered all of it. The only other thing is you have the 5-year rule, which could become a 6-year rule for some people. So if you had an IRA payable to an estate and the person died, the plan owner died between 2015 and December 31st, 2019, instead of having to be paid out within 5 years, it's now 6 years. This does not apply for those who died in 2020. So if there's a beneficiary who would be subject to the 5-year rule in 2020, they're still going to have the 5-year rule.
Okay, very good. On page 84, you don't have to take your required minimum distributions now until the calendar year after you have reached age 72. It was 70 and a half. That rule was changed late last year. Also, if you're charitable, you can continue or consider to have money, if you're over 70 and a half, to have money passed directly from your IRA to a charity. That way you don't pay any tax on the withdrawal, and the charity gets the money and doesn't have to pay tax. So it can be better than a charity, and you don't have to worry about the adjusted gross income limit. So that's called a qualified charitable distribution. The other change they made last year was that it used to be once you were 70 and a half, you could no longer make IRA contributions even though you had earned income. Now you can make IRA contributions as long as you want, but if you make IRA contributions after 70 and a half, they will reduce the tax deduction or the ability to move an IRA to charity. So if you've made $15,000 of IRA contributions since you became 70 and a half, under this law, then you would only be able to make an $85,000 transfer of IRA to charity, and then the next year you could do the 100. That may be a little bit confusing, but it is explained in the PowerPoint slides, and it must be true because it's in the PowerPoint slides.
And when Alan says direct, you can't. What he means is you can't receive the funds at all and then contribute them. You have to actually have your plan distributed directly to the charity. If it comes into your name at all, then you won't qualify.
Right. And certainly a lot of charities have a lot more need this year. By the way, if you have a charity, then your charity can file under the EIDL program for a $10,000 check from the government. That's what the Sarah Gassman Music Foundation has done. And we're going to use that money to buy computers and organs for the children so that they can take lessons at home and also get their schoolwork done at home. So that's what we're going to be doing with our $10,000 check. You can be thinking about what you'll do with your $10,000 check. Page 86, life insurance is a little bit harder to get right now because the carriers are not getting the records from the doctor's offices that have shut down. The life insurance rates may go up next year because of the virus, but the life insurance carriers are not allowed to raise their rates without approval, and that only happens once a year. So if you don't have enough life insurance, now would be the time to go ahead and file an application and get with a life insurance agent and get that life insurance written while you're healthy and while the insurance carriers are writing it at today's rates instead of tomorrow's rates. Page 87, if you have an estate tax issue, meaning that you and your spouse are worth more than $23 million, or if the exemption goes to 1/2 of what it is now, which is programmed to occur in 2026. So it would go from 11,580,000 to half of that in 2026. You have the opportunity to sell some of your assets or part ownership of your family LLC to a trust for your spouse and descendants in exchange for a promissory note. And that promissory note can have a very, very low interest rate. So I could loan $1 million to a trust for my wife and children, and if it is a 15-year loan, they would only have to pay me 2.15% a year. Hopefully those investments would earn much more than that, and the differential is estate tax avoidance for me. In addition, I can pay the income tax on the income of the trust that I sell these assets to, and I don't have to pay any income tax on the note I get back. So a lot of the people on the call have done these installment sales. They're very popular. We have a YouTube video that explains them on page 87. You can click on that link, or we can send you the link and you can watch it. But it's really the very best planning arrangement we have for estate taxable clients. And they end up with a logistical chart like this at page 89, which I don't have time to cover, but a few of you have these. And we'd love to have you come see us so we can update your chart and have you sell more assets to the family or more interest in the family LLC now using this. Unfortunately, many people will face short life expectancies this year, particularly senior citizens who are diagnosed with the virus. So if you get that diagnosis and you are estate taxable, the bad news is you have the diagnosis. The good news is that there is a loophole called the self-canceling installment note, which would allow family members to owe you money under a note that vanishes when you die. So if you have $20 million worth of assets and you sell $10 million to your family in exchange for a $10 million note that cancels when you die, and then you die, the note cancels, and you have no estate over $10 million, you don't have to file an estate tax return, and you just saved about $3.5 million in estate taxes. I'm not going to go through the nuances and the niceties of how to set these arrangements up, but I have said to many of you, joshingly or seriously, if you ever get a bad medical decision, you get a bad diagnosis with a short life expectancy, call your family first and me second. Because if we can put this in place while you have better than a 50% chance of living at least 1 year, then this can wipe out all your estate tax. And we've had clients save hundreds of millions of dollars in estate taxes using these short life expectancy techniques. We put it into place. If things don't go well and the client dies, then all the estate tax is avoided. If things go well and the client lives, then we reverse the mechanism. And it's, like I said, it's just something worth thinking about, making lemonade out of lemons. There's a lot of technicalities that the professional advisors can read about, how we've found what we think is a much better way to do it than just a self-canceling installment note. Page 97, I think a lot of you on this call spent some painful time with me in 2008 through 2012, fighting with creditors, negotiating with creditors, coming up with plans to do what's best for a family. Please don't think that there's not a risk of a significant recession only weeks away. Whether that's a 5% risk or a 55% risk, I don't know. But what I do know is that if you have $1 million building with $750,000 mortgage on it, that building could be worth $600,000 in the next 2 months. Then the bank could be knocking on your door and asking you to put money in. You might negotiate the bank down. It depends on what assets the bank can reach. What is your situation today from a creditor protection standpoint? One thing we want all of our clients to know is, if the doomsday happens today, real estate isn't worth what it's worth today, I'm in a car accident, somebody sues me, what can I keep and what do I lose if I have to go into bankruptcy to get rid of a judgment? The planning that you do before is 100 times more effective than the planning that you do after. Remember, it wasn't raining when Noah built the ark. That's how it worked. So there's a lot of things we can talk about. There's a lot of slides here. There's a lot of pervasive reasons. If you have a company right now that is or may become insolvent, unable to pay its debts, then you want to be very careful how you conduct yourself, because you have a duty to the creditors to act reasonably. And that's not logically, that's based on the laws, the federal law and the state law. So we've already done a number of consults with a number of clients and bankruptcy counsel, just being ready. We hope for the best, but we plan for the worst. And a lot of clients, believe it or not, get their debt reduced because things are so bad, and then have to pay the IRS because the reduction of debt constitutes income. Now, that's not going to apply if you can get a PPP loan from the Small Business Administration and it's forgiven. But it is going to apply in a lot of foreclosures. So if you have leveraged real estate, highly leveraged real estate in an LLC, and it's not taxed as an S corporation, then read our slides, talk to me, talk to our advisors, get us to send you a copy of our article on CREST, C-R-E-S-T, which may solve a lot of the issues. I decided not to edit out these slides, thinking that people might want to read them if they're having trouble sleeping at night, or they're tired of playing ping pong with their significant other. Ping pong tables are a lot of fun, still being delivered by Amazon, wholesome, clean, although you could bet too. I have a lot of slides here on bankruptcy law. I'm not going to play these. I'm not going to go through these slides, but I will say, if you've guaranteed a lease for somebody and their company goes bankrupt, you may owe the creditors the last 12 months' rent paid by their company, even though they never defaulted on their rent, because of the preferential transfer laws. So if you have a guarantee out there, or you have a business that may go under, please don't just assume that everything's going to go well and assume that however you spend the money is fine. There's a lot of different ways to spend the money. Page 126, you might ask your CPA to go over our creditor protection maintenance list. Make that one thing that your CPA does with you once a year. We have a lot of materials on asset protection. If you want more information, just send me an email, put in the RE line, whatever you want the information on. You could put RE asset protection, RE ping pong tables, RE charitable foundations, whatever you like. We'll make sure we send that to you. I'm going to mention the last slides, and then we're going to spend the rest of our time on the loan program. The last slides, which you don't have here, and which I'm going to discuss with a client this afternoon who can't get her money back from a hotel, is that under Florida law, if you have a legal obligation, but it becomes impossible due to an act of nature to perform, then you may be excused from that performance. And that is called an act of God clause. And there are also defenses of impracticability. Lawyers are going to be very busy, but if you have contracts and you think you're going to have to pay someone money or they're going to have to pay you money and you're not concerned, you're not sure exactly what to do, it's better to get advice and to do the right thing than to guess and possibly do the wrong thing. So Brandon, let me turn it over to you. You've got about 13 minutes, which in our firm is 3/10 of a billable hour, as we jokingly say, and tell us what you can tell us in this period of time about the SBA loan programs, because I think even if you're not going to borrow, it's just interesting how they're put together.
Yeah. So first, before we get there, there's a couple of alternatives to the actual loan programs where if you want this, you can't apply for the loan. And one of those is this employee retention credit. And what this does is it gives you a refundable payroll tax credit for up to 50% of the wages that you pay to employees. Now, this is limited to $10,000 per employee in wages, so you get a max credit of $5,000 per employee. Now, in order to be eligible for the credit, you have to have your operation of your business fully or partially suspended due to a government order, such as the Florida stay-at-home order, or your gross receipts are less than 50% of the gross receipts as compared to the same quarter last year. So you're looking at first quarter 2019 compared to fourth quarter 2020. If 2020 is 50% of those gross receipts, you're eligible. And that applies all the way up into the time where you get back to 80% of your gross receipts as compared to the same quarter in the previous year. So this could last for 2 or 3 quarters, but you are limited to $5,000 per employee. So that is available as an option. For the most part, though, the PPP loan program is going to be the better option. You're going to get a little more benefit. But I have some slides here just comparing those. You also have the ability to delay the payment of your payroll taxes. This is only the 6.2% Social Security payroll tax. You can defer that and pay 50% in 2021, 50% in 2022. But this does not apply if you even get $1 of forgiveness under the Paycheck Protection Program that I've been talking about. And so these are just some alternatives here. But now moving to the actual loan programs, there are 2 programs. We have the EIDL, Economic Injury Disaster Loan, and then the PPP loans, which are the Paycheck Protection Programs. Now, there's a little bit different eligibility requirements, but generally, small businesses, independent contractors, sole proprietors with less than 500 employees can qualify for this as a general rule. Now, for the EIDL loan, you have to have suffered substantial economic injury as a result of the declared disaster to be eligible. If you are eligible for that, you can go to this website here. We have the link that you can click on. You fill out a simple application, putting in your business name, the owners of the company, your EIN numbers, and then you'll need your gross receipts from the last year, your total number of employees, and then cost of goods sold. If you don't have cost of goods sold, such you may be a doctor or a lawyer that's in the service type industry, we don't have cost of goods sold. We just provide services, so you put a 0 in that box. And then you can apply for the loan, fill in your banking information, and you're supposed to get a $10,000 grant from the government within 3 days of submitting that. Now, we've talked to a bunch of people. We filled out helped a lot of people with these applications. We don't know of anybody that's got the $10,000. So we're still waiting to see how that's exactly going to work. But that is the idea. There's limitations on what you can use the funds for. They're down here on the bottom left. But it's a pretty liberal list. The last one there, number 6, repaying obligations that cannot be met due to revenue losses. That's a pretty broad category, so there's not a whole lot of limitations on what you can actually use this loan for. Now, on the other side, we have the Paycheck Protection Program. And under this loan, you're eligible if the uncertainty of the current economic conditions make the loan necessary to support the ongoing operations of the business. So certainly here in Florida, a lot of us have been impacted. We have a stay-at-home order. We're not sure what clients are going to do. We're not sure how quick we're going to recover. There's a lot of uncertainty here. So I think for the most part, a lot of people can qualify for this. But you have to think about too, what do I have in the bank? If I have $1 million in the bank, it only costs me $200,000, a month to support my business. Am I really uncertain about my ongoing conditions? Probably not. It's probably not going to last more than a month or two, hopefully. So you got to consider that as a factor. But if you are eligible, you can get 2.5 times your monthly payroll costs, or up to $10 million. But for most people, it's going to be 2.5 times your monthly payroll costs. And we'll go through what those actually are. But you're permitted to use the Paycheck Protection Program. 75% of this has to be used on payroll costs, and that includes your health care benefits, retirement plan contributions, medical sick leave as well. You can use it to pay mortgage interest payments, not principal. You can use it to pay your rent. You can use it to pay interest on debt, but not principal that was incurred prior to February 15th, and then you can use it for utilities. Now, the Paycheck Protection Program is going to be forgivable to the extent during this 8-week period after the date of the loan, we use the funds towards payroll costs, mortgage interest, rent, and utility. So after the date of the loan, we add up all of our expenses that we use for these costs. And if we exceed the value of our loan, our full amount is given. If it's less than what we got on the loan, then we have to pay back that excess. And the excess is going to be payable back over 2 years at 1% interest. Now, there's a couple of other rules that could require you to pay back a portion of the loan that you get. One is if you get that $10,000 grant, that's going to reduce the amount that you're eligible for forgiveness for. So you might have to end up paying back $10,000 at the end of the day. And then if you reduce your number of employees during that 8-week period as compared to the prior year, then you might have to pay back a portion of the loan. So as an example, if we had 20 employees last year, we get the loan and we only have 19 during this 8-week period. So we had 5% less than we did the previous year. You're probably going to have to pay back 5% of the loan. Same thing applies if we have employees making less than $100,000. We can exclude the ones over $100,000, but if we reduce the salary of anyone making less than $100,000 by more than 25%, that's going to reduce the portion that you're allowed to be forgiven, and you're going to be required to pay back some of that. Now, there is an exception here that if you correct that reduction prior to June 30th, then you're going to be okay, as long as you made the change before April 27th. So if we let someone go before April 27th, we have the ability to bring them back by June 30th to eliminate the reduction of their number of employees. If we fire them after that date, after the April 27th date, then I don't think we have that extra room, and we're going to have a portion of our loan reduced. So we need to be thinking about those items if we're getting these loans. Now, the economic injury disaster loan, that's going to come directly from the SBA. The Paycheck Protection Program, you're applying through your bank. A lot of banks have indicated that they are only servicing their existing business customers. If you have an account with them, they're going to get to you first. They're prioritizing those types of customers and maybe not even accepting applications if you don't have a bank with an account with them. So you really need to search out your bank, get on their list, and get these applications submitted as soon as possible. They came out and said that these are going to be given on a first-come, first-served basis. So once the funds run out, they are no longer going to be available. Now, as far as calculating, there's really 3 different tests here. It's how much can you borrow, how much can be forgiven, and then what can I use the funds for once I get them. So we're determining how much to borrow. That's the 2.5 times your average monthly payroll cost. This list here is everything that can be included. It's salaries, wages, commissions, similar compensation, cash tips if you're in the restaurant industry. If you don't have documentation of those tips, the regulations allow you to just make a reasonable estimate of what those tips would have been, and you can include those as a payroll cost. We get sick leave, family medical leave, vacation pay, severance pay if you are paying any severance. We can include health care benefits, including insurance premiums, retirement plan benefits, State and local taxes and payments to independent contractors are not going to account. It's only your employees. Independent contractors get to apply on their own and have their own application. Now, the payroll costs that you get to count for this 2.5 times test are limited to $100,000 per employee. So you can only count that first $100,000 of wages that you pay, but that $100,000 limitation only applies for these first 4 items. You can include, in addition to the $100,000, healthcare benefits, retirement plan contributions, and state and local taxes. So you can get above and beyond that $100,000 per employee. Now, once we get the loan, we determine how much we can borrow. We're into how much can now be forgiven, and that is that 8-week test where you have an 8-week period after the date of the loan that you spend expenses for these items, and that is going to be the amount that can be forgiven. So we have payroll costs, including everything over here, including retirement plan contributions. So if you are worried about maybe not getting to your payroll costs, you can make a retirement plan contribution, even if it's for yourself, and that's going to be included as a payroll cost. That's a nice way to help bump up those expenses. You can increase your salary, but you can only count up to $100,000. I know we've talked about this in prior webinars. If you have a spouse that's being underpaid on the payroll for doing their job for the business, you can increase their compensation during this time to help get your 8-week expenses up to that payroll cost and make sure the loan is fully forgiven. We can pay interest on mortgages and rent, but only those obligations that were in place prior to February 15th. So if we're paying rent to a related party, that's okay, but we can't jack up that rent to satisfy our loan forgiveness. We have to have it in place before February 15th for it to count. We can also make utility payments, and then again, the amount is reduced by that $10,000 grant, and then you have reduction for employees and reduction for salary reductions if those apply. And then over here on the far right, what can we use the loans for? Payroll costs, payment of expenses, rent, utilities, etc. We can pay interest on mortgage debt even when the rates increase after February 14th or February 15th, but that's just not going to count for our forgiveness. Same thing for the rent obligations. If we increase the rent, that's an allowable cost. It's just not going to help us towards that forgiveness test. So we have the applications here as a sample. This is the EIDL application. As you can see, it's fairly simple. These are the 2 that you might need help from, a CPA or another advisor, to get your gross revenues for the 12 months prior to the date of the disaster. So that's January 31st, 2020, back through January 31st, 2019. Again, your cost of goods sold, not relevant for professional services, but if you do have cost of goods sold, you enter that here. Rental properties, you put in your lost rent due to disaster, and then your nonprofits are putting in their cost of operations rather than gross revenues for the 12 months to base their loan off of. So not a whole lot of information to fill out here for the EIDL loan. This box is important. Make sure you check that you would like to be considered for the $10,000. You put in your banking account information, and then according to the statute, you're supposed to get that within 3 days, but as we know, it's been a little bit longer than that for a lot of people.
I think last night, Vice President Pence said that it would be another week. Last week, the Treasury Secretary said that it would be 3 days. So I'm sure they're trying.
Yeah.
Let's go back to
the Paycheck Protection Program application as well for you to look through as well.
Yeah, so we have all these on the slides, and then we have, you should have gotten our Dear Client email, which provides you with the names and click here's to see our previous webinars, which include a lot more detail on all of this. So can we go back to the cover page, John?
Yep.
So you've got our email addresses here. You know our phone number. 727-442-1200. Let us know if you have any questions. Let us know if there's anything we can do to help you. Beyond law, if you need a recommendation of a CPA, if you need a recommendation of a banker, you need the recommendation of somebody who can go shopping for you or make a delivery so you don't have to leave your house, you need a recommendation for a doctor, anything like that, let us know. We are More than glad to help. We are replaying this webinar at 5:30. You're welcome to watch it again. Tell all your friends or even people you don't like about it. And then we'll also send a link so that it can be watched on demand. If you would like for us to present future webinars on any other topics, please let us know. I'm also giving you greetings from Ken Crotty and Christopher DiNicolo, my partners. They are also doing well and working hard and taking care of their families as we all do. Hope you have a great day. Thanks so much for allowing us to serve you. And once again, thank you.